Did you know you can get a first-time home buyer loan with as little as $1,000 down?
That's right, for just $1,000, you can start building equity in a home, rather than throwing away money on rent. In fact, the average renter pays over $15,000 per year in rent, which could be going towards a mortgage instead. This video is designed to help first-time home buyers understand their loan options and navigate the mortgage planning process. By the end of this video, you will learn how to qualify for a first-time home buyer loan, the different types of home financing options available, how to navigate the mortgage planning process, and how to avoid common mistakes in home buying.
What is a first-time home buyer loan?
A first-time home buyer loan is a type of mortgage loan designed for borrowers who have never owned a home before. These loans often have more lenient credit score requirements and lower down payment options, making it easier for first-time buyers to qualify. For example, the FHA loan requires a credit score of at least 580 and a down payment of just 3.5%.
This can save you thousands of dollars upfront and get you into a home faster. How to qualify for a first-time home buyer loan?
To qualify for a first-time home buyer loan, you will need to meet certain income and credit score requirements. For instance, the USDA loan requires a credit score of at least 640 and an income that does not exceed $103,000 per year. You will also need to provide documentation of your income and employment, such as pay stubs and W-2 forms. Additionally, you will need to have a debt-to-income ratio of 43% or less, which means that your monthly debt payments cannot exceed 43% of your gross income.
Exploring home financing options.
There are several home financing options available to first-time home buyers, including conventional loans, FHA loans, VA loans, and USDA loans. Each of these options has its own set of benefits and drawbacks, and the right choice for you will depend on your individual circumstances. For example, VA loans offer $0 down and lower interest rates, but are only available to eligible veterans. On the other hand, conventional loans offer more flexible credit score requirements, but may require a higher down payment.
Mortgage planning and credit score.
Your credit score plays a critical role in the mortgage planning process, as it will affect the interest rate you qualify for and the amount you can borrow.
A good credit score can save you thousands of dollars in interest payments over the life of the loan.
For instance, a credit score of 760 or higher can qualify you for an interest rate of 3.5% or lower, which can save you up to $10,000 per year in interest payments. On the other hand, a credit score of 620 or lower may result in an interest rate of 5% or higher, which can increase your monthly mortgage payments by up to $500. How to avoid common mistakes in home buying. One of the most common mistakes first-time home buyers make is not budgeting enough for closing costs. Closing costs can range from 2% to 5% of the purchase price, and can include fees for title insurance, appraisal, and inspection. For example, on a $200,000 home, closing costs could range from $4,000 to $10,000. It's essential to factor these costs into your budget and plan accordingly, to avoid last-minute surprises and delays in the home buying process. If you're ready to start exploring your first-time home buyer loan options, click the link in our description to download our free guide to mortgage planning. This comprehensive guide will walk you through the entire process, from qualifying for a loan to closing on your new home.
Don't wait, start your journey to homeownership today.